So let's begin our journey together. Before we get lost in articles and deadlines, let's step back and ask a simple question. Why does DORA even exist? Think about how much of your bank runs on software now. You probably haven't walked into a branch in months, right? That shift is exactly what worried regulators. In this opening chapter, we're going to build your foundation. First, we'll trace how DORA was born, moving from a messy pile of voluntary guidelines into one hard law. Then, we'll explore why a tech outage in finance isn't just an IT headache, it's a threat to the whole system. We'll walk through the 5 pillars that hold DORA up, so you always have a map in your head. After that, we get practical. Who actually has to comply? Is it just big banks or your cloud provider too? And what about a firm sitting in New York or Singapore? We'll answer all of that. Finally, we'll look at the supervisors watching over this and how you should prioritize your own gap analysis. Here's why this matters. By the end of this chapter, you won't just know what DORA is, you'll understand the thinking behind it, and that understanding is what makes you genuinely useful in a compliance role. Ready? Let's dive in. Let's start with a bit of history, because it explains everything that follows. Before DORA, how did Europe handle technology risk in finance? Honestly, it was a patchwork. Banks followed one set of guidelines, insurers another, investment firms yet another. And here's the catch, most of these were just guidelines, soft expectations. A regulator could say, you really should do this, but there were no real teeth behind it. Imagine a school where every classroom has different rules and none of the teachers can actually give detention. That was the pre-DORA world. Each supervisor did their best, but firms could interpret, delay, or quietly ignore. Then came the EU's digital finance package, and with it, a decision. Enough with the suggestions. Let's make one binding law that applies directly across every member state. That's what makes DORA a regulation, not a directive. It doesn't wait for each country to rewrite it into local law. It applies as is, the same in Dublin, Frankfurt, and Rome. DORA was adopted in 2022 and became fully applicable in January 2025. So when we talk about it today, we're not talking about something coming someday. It's here, it's live, and it's enforceable. That single shift from advice to obligation is the story of this entire course. Now let's meet the 3 players who shaped the world before DORA. We call them the European Supervisory Authorities, or ESAs. There's the EBA for banking, ESMA for markets, and EIOPA for insurance. 3 authorities, 3 sectors. Keep that in your head because they come back again and again. Before DORA, each of these issued their own guidelines on technology risk and outsourcing. And they were genuinely good documents. But here's the problem I want you to feel. They didn't always line up. A bank and an insurer could face quite different expectations for the very same cloud service. Picture 2 siblings given different curfews by different parents. Confusing and a little unfair. There was another issue. These guidelines mostly worked on a comply or explain basis. So a firm could say, we're not doing this and here's our reasoning. And that was often the end of it. Outsourcing rules existed, sure, but they were thin on the hard stuff, like mandatory testing or strict incident timelines. So why does this matter to you? Because DORA didn't appear from nowhere. It took all this scattered wisdom, pulled it together, and made it binding and uniform across all 3 sectors. When you study DORA, you're really seeing years of fragmented effort finally brought into one rulebook. Let's put some dates on the timeline, because in compliance, dates matter enormously. But don't worry, I won't make you memorize a calendar. I just want you to understand the rhythm of how DORA arrived. It started back in September 2020, when the European Commission published the proposal. Think of that as the first draft, the moment someone said, here's what we think the law should look like. Then came the negotiation phase, where the institutions debated and refined it. By 2022, they reached agreement and adopted the final text. Now, here's a distinction students often trip over. There's entry into force and there's application. DORA entered into force in January 2023, but it didn't actually start applying to firms until January 2025. Why the gap? Because lawmakers gave the industry a 2-year runway to get ready. Think of it like getting your exam date well in advance. The exam is set, but you've got 2 years to study. Now ask yourself honestly, did every firm use that time wisely? Many did, some didn't, and they're scrambling now. The lesson here is simple but powerful. Regulators rarely spring things on you overnight. They signal early. The firms that listen are the ones that stay calm when the deadline finally lands. Here's a question I want you to sit with. Why does a regulator care so deeply about one bank's IT systems? Surely that's the bank's own business. Well, let me change your mind. Think about what happens when a payment system goes down for even an hour. People can't pay for groceries, salaries don't land, businesses can't settle invoices. Now multiply that across an interconnected financial system where everyone depends on everyone else. Suddenly, one firm's technical glitch becomes a public problem. That's what we mean by systemic risk. The danger isn't contained, it spreads. Let me give you a real flavor of this. A few years ago, a major outage at a single cloud provider knocked dozens of services offline at once across totally unrelated companies. Why? Because they all quietly relied on the same plumbing underneath. None of them planned to fail together, but they did. That's the regulator's nightmare. Finance runs on trust, and trust is fragile. If people stop believing their money is safe and accessible, the whole machine seizes up. So here's why this matters for you. DORA treats operational resilience as a matter of financial stability, not just good housekeeping. Once you see ICT risk through that lens, every requirement that follows starts to make complete sense. Let's build on that systemic idea, because there are two specific dangers I want you to really understand. The first is concentration risk. The second is interconnection risk. They sound technical, but they're actually quite intuitive. Start with concentration. Imagine an entire town where every restaurant buys bread from the same single bakery. The food is great, everyone's happy. But what happens the day that bakery catches fire? Suddenly, nobody in town has bread. That's concentration risk. In finance, a huge number of firms rely on just a handful of big cloud and technology providers. So one provider's bad day becomes everybody's bad day. Now add interconnection. Financial firms aren't islands. They are wired together, constantly passing transactions and data back and forth. So a problem at one firm can ripple outward like one tipped domino knocking over the next. The trouble doesn't stay put, it travels. So here's the honest reason DORA had to step in. Voluntary, firm-by-firm measures simply can't manage a risk that's shared across the whole sector. No single bank can fix concentration on its own. That's why DORA introduced something genuinely new: direct oversight of those critical providers themselves. Sometimes, the only way to protect the village is to keep an eye on the bakery. Alright, here's the moment where DORA stops feeling abstract and starts getting a shape. Everything in this regulation hangs off 5 pillars. Learn these 5 and you've got the skeleton of the entire law in your head. I promise this makes the rest of the course so much easier. Pillar 1 is ICT risk management. This is the foundation, the governance, the controls, the whole framework for managing technology risk. Think of it as the house rules. Pillar 2 is incident reporting. When something goes wrong, how do you classify it and tell the regulator, and how fast? Pillar 3 is resilience testing. It's not enough to say you're prepared, you have to prove it, including advanced threat-led testing for the bigger players. Pillar 4 is third-party risk management. Remember our bakery? This pillar is all about overseeing your providers and contracts. And Pillar 5 is information sharing, where firms voluntarily swap intelligence about cyber threats. So here's a little trick. Whenever you read a DORA requirement and feel lost, just ask yourself, which pillar does this belong to? 9 times out of 10, that one question brings instant clarity. We'll spend whole chapters on each pillar, but for now, just hold these five in mind. Now let's have an honest conversation, because there's a myth I want to bust. Some people panic and think DORA is 1,000 brand new rules dropped from the sky. It isn't. A lot of it, frankly, is good practice that responsible firms were already doing. So let's separate the truly new from the familiar. What's genuinely new? Three things stand out. First, mandatory threat-led penetration testing for significant entities, meaning realistic intelligence-led attacks on your own systems. Second, harmonized incident reporting with strict ticking deadlines. And third, this is the big one, direct EU oversight of critical third-party providers, regulators reaching past the bank to supervise the tech company itself. That's new. And what's familiar? Honestly, the rest. Good governance, sensible risk management, careful outsourcing. Mature firms had versions of these already. So what actually changed? Think of it like this. Imagine a workplace where being tidy was always encouraged, but never required. Then one day, it becomes company policy with inspections. The behavior isn't new, but the obligation is. That's DORA. It takes "you really should" and turns it into "you must" and we'll check. For you, the takeaway is reassuring. You're not starting from zero. You're raising the bar on things the industry half knew already. Let's tackle a question everyone asks first. Does DORA apply to me or to my client? Because if you don't get scope right, everything else is just guesswork. So let's walk through who's actually caught by this law. DORA casts a wide net across financial services. We're talking credit institutions, which is the formal term for banks. Then, payment institutions and e-money institutions. Think of your favorite payment app. Add investment firms, trading venues, and the market infrastructure that keeps trading flowing. But it doesn't stop there. Insurance and reinsurance undertakings are in, along with insurance intermediaries. And here's a modern twist. Crypto asset service providers and certain blockchain-based entities are explicitly covered. The lawmakers clearly looked ahead. There's also a long tail of others, like data reporting service providers, all listed under Article 2. Here's my honest advice from the field. Don't assume. I've seen firms confidently say DORA doesn't apply to us, only to discover a small licensed entity buried inside the group that absolutely does. So the very first task in any DORA project is unglamorous but vital. Open Article 2 and methodically check every legal entity you run against that list. Scope before strategy, always. Now here's where DORA does something quite bold, and I want you to appreciate just how unusual it is. Normally, a financial regulator regulates financial firms. Makes sense, right? But DORA reaches further. It reaches into your suppliers. Let's break it down simply. Every ICT provider serving a financial entity now carries obligations flowing through the contracts they sign. That's the baseline. But then there's a special category, the critical third-party providers or CTPs. These are the giants, the providers so important that if they failed, the whole sector would shudder. Remember our bakery that supplied the entire town? That's a CTPP. For these critical providers, DORA creates direct EU oversight with a lead overseer assigned to watch them. So a cloud provider could find a European regulator knocking even though it isn't a bank at all. That's genuinely new in the world of finance. And here's a subtlety students love to miss. It's not just your direct supplier. You have to map the chain beneath them, the subcontractors, what we call fourth-party risk. Think of it like checking not just your contractor, but who your contractor hires. Even providers inside your own corporate group can be in scope. So the lesson is, know your suppliers and know their suppliers too. Here's something that genuinely surprises people about DORA, and it's a pleasant surprise. The law isn't one size fits all. The regulators were sensible. They knew you can't expect a tiny 10-person firm to do everything a massive global bank does. That idea has a name, proportionality. Let me put it plainly. Proportionality means your obligations scale with your size, your risk, and your complexity. So a small, low-risk firm carries a lighter load than a systemically important one. It just makes sense, doesn't it? You don't ask a corner shop to install the same security as a national bank vault. For the very smallest firms, the micro enterprises, DORA even offers a simplified ICT risk management framework. It's a lighter version designed to be achievable without crushing them under paperwork. But, and this is important, don't celebrate too early. You can't just declare yourself small and relax. You have to actually assess which category you fall into and, crucially, document why. Here's a real lesson from practice. A regulator will happily accept a proportionate approach, but only if you can show you're working. If you simply assumed you were exempt and skipped the analysis, that's a finding waiting to happen. So enjoy the flexibility, but earn it with evidence. Let me ask you something. If your firm sits in New York or London or Singapore, can a European law really reach you? It's a fair question, and the answer makes a lot of people sit up straight. Often, yes, it can. Here's how it works in practice. If a non-EU financial entity serves EU clients, DORA's expectations can follow it. And for ICT providers outside Europe, DORA reaches them through a clever channel, the contract. Picture a European bank using an American software vendor. To stay compliant, the bank must put DORA-style clauses into that contract. So suddenly, that American vendor is meeting European requirements not because Brussels phoned them, but because their customer insisted. I've seen this play out firsthand. A US-based technology firm I worked with was baffled at first. We're not in Europe. Why are we filling in these resilience clauses? The answer was simple. Their biggest client was an EU bank, and that bank had no choice but to push the obligations down the chain. So the takeaway is this. Don't think geographically, think relationally. Ask, who do I serve and who serves them? And keep watching the guidance, because how authorities enforce this across borders is still maturing. In our connected world, regulatory reach rarely stops at the coastline. Let's talk about who's actually watching, because DORA has a whole cast of supervisors and it helps to know who does what. Otherwise, it feels like alphabet soup. So let me untangle it for you. At the ground level, you've got National Competent Authorities, or NCAs. These are the regulators in each member state who supervise firms day to day. Think of them as the local police, close to the action. Then, sitting above, you've got our three friends from earlier, the ESAs, the EBA, ESMA, and EIOPA, coordinating at the European level so things stay consistent across countries. To keep those three aligned, there's a joint committee. Think of it as the meeting room where the three authorities sync up and avoid contradicting each other. And for those critical providers we discussed, there's a special role, the lead overseer, assigned to supervise each one directly. Now, here's why this architecture matters to you in real life. When you have a cross-border incident, regulators don't work in isolation. They share information and cooperate. So you can't tell one story to the regulator in France and a different story in Germany. The system is joined up. My advice? Know which NCA owns you. Build a relationship before you ever need one. And never assume the left hand doesn't talk to the right. It does. Let's zoom in on one of DORA's most fascinating creations, the lead overseer. This is the mechanism that lets Europe supervise a tech giant that isn't even a financial firm. I find it genuinely clever, so let me walk you through it. Once a provider is designated as critical, one of the ESAs is appointed as its lead overseer. Think of it as assigning a dedicated case officer to that single, hugely important supplier. And this overseer has real powers. It can request information, conduct inspections, and run investigations. It can also issue recommendations that the provider is expected to follow. Now here's a clever bit of leverage. What if a critical provider drags its feet and won't cooperate? The overseer can effectively recommend that financial entities stop using that non-compliant provider. Imagine being a cloud giant and hearing that your customers might be told to walk away. That's a powerful incentive to behave. And where do you fit in this? Well, financial entities have to cooperate with this oversight too. You can't sit on the sidelines. There's even a fee mechanism where critical providers help fund their own supervision. So picture it like this. The town finally hired an inspector just for the bakery, and the bakery pays part of the inspector's salary. Strange, but effective. So we've covered a lot of ground. Now let's make it personal and practical. How do you actually figure out what DORA means for your specific firm? Because here's the truth. DORA is not the same workload for everyone. Your job is to find your own version of it. Start with the obvious question. Are you even in scope? Go back to Article 2 and confirm whether your firm and every entity in your group is a covered financial entity. Don't rush this. Then ask the next question. Do you qualify as a micro enterprise, which would unlock that simplified framework we talked about? That single answer can dramatically change your obligations. Next, work out which requirements apply in full and which apply in a lighter form. And don't forget your suppliers. Map your ICT providers and flag any that might be critical because that affects you too. Here's a real-world tip I always share. Treat this like a doctor's diagnosis before any treatment. You wouldn't prescribe medicine without first understanding the patient, would you? Same here. Do the assessment, then build the program. And whatever you conclude, write it down. That documented assessment becomes the foundation, the very first artifact of your entire compliance journey. Get this right, and everything downstream gets easier. Let's close this chapter with the question that keeps compliance officers up at night. Where on earth do I start? You've seen how much DORA covers. Trying to do all of it at once is a recipe for burnout. So let's talk smart prioritization. First, a reality check. DORA has applied since January 2025. So this isn't a future project you can ease into. Enforcement is live, right now. That changes your mindset from someday to today. So how do you sequence the work? Begin where the regulatory risk bites hardest. For most firms, that means incident reporting and third-party risk, because those have sharp deadlines and visible obligations. A big early task is hunting down contracts that don't meet DORA's clause requirements, what we later call Article 30 remediation. That backlog can be huge, so start early. Here's how I'd frame it for your board. Imagine triage in a hospital emergency room. You don't treat patients in the order they arrived. You treat the most critical first. Apply that same logic. Sequence your remediation by regulatory exposure and business criticality, not by whatever's easiest. Then package it all into a clear roadmap with owners, milestones, and evidence. A calm, prioritized plan beats a panicked scramble every single time.